It is 9/7 on a Monday morning. You are sitting in a conference room on the third floor. The chairs are the kind that look ergonomic but are not. There is a whiteboard behind your manager's head with last quarter's targets still visible under a partial erase. Your manager's name is Renata. She is organized and direct, and she has been with the company 11 years. She clicks to slide 4 and says the client deliverable moves to the 14th, not the 21st. She looks at you when she says it because you are the one who will have to adjust the timeline. You write it down. You say understood. You mean it. You own the company. Not a piece of it. Not a minority stake that gives you bragging rights and nothing else. You own the majority. You control the board. The board that Renata, in the long structural sense, ultimately answers to. She does not know this. The 3 other people in this room do not know this. The person who schedules the conference room does not know this. You have not told anyone at this office, and you are not planning to. This is not a story about a secret that destroys something. This is a story about a structure that builds something quietly while you keep showing up. The company is not glamorous. That is important to understand from the beginning. There is no logo you would recognize. The product is not in a Super Bowl commercial. Revenue runs between $8 and $12 million annually, depending on the year. The customers are steady and institutional. They have been ordering from this company for 7, 10, sometimes 15 years. They do not switch vendors easily because switching is expensive and the product works. There is no drama here, there is no cult following, there is a reliable receivables cycle and a building with adequate parking and a coffee machine in the break room that nobody refills until it is completely empty. This is exactly the kind of company that changes someone's life without anyone noticing. You are an employee here in every formal and visible sense. You have a job title, you have a direct manager, you have a W-2 that arrives in January and goes to your accountant and reflects your salary accurately and completely. You pay your taxes, you sit in the all-hands meetings, you eat lunch at your desk more often than you should, you know which bathroom on the second floor has the broken soap dispenser. None of that is performance. All of it is real. What is also real is that you went through a process 18 months ago that most people in this building have never thought about and would not have known how to execute. You identified this company, you analyzed it, you secured financing against its own cash flows. You structured an acquisition through an entity your name runs but does not headline in casual conversation. The previous owner retired to somewhere with better weather. The transaction closed on a Thursday afternoon. You drove home in traffic and made dinner and watched 40 minutes of something forgettable and went to sleep. On Friday, you came back to work and opened your laptop and answered the email that had been waiting since Wednesday. The ownership structure is clean and legal and documented in full. Your attorney knows, your accountant knows, the bank that financed the acquisition knows, the state in which the entity is registered knows. There is no concealment of material financial fact. There is no tax fraud, there is no shell game. There is a holding company that owns the operating company, and that holding company has one majority owner, which is you, and everything flows through properly and gets reported properly. And the IRS has never had a reason to be confused about any of it. What you are not doing is announcing it at the Monday morning meeting. The reason for that is not fear. The reason is function. The business runs because people come in and do their jobs without the distraction of knowing that the person in the corner office used to sit 3 desks from the coffee machine. Renata manages the team. The team delivers the work. The customers receive the product. The receivables cycle continues. That machine does not benefit from you inserting yourself into the center of it. It benefits from you staying invisible inside it while the structure does what you built it to do. You have what amounts to a social contract with the operation. You keep the social layers intact. You do not use your ownership to override Renata's decisions in the hallway. You do not accept special treatment you did not earn as an employee. You do not pull rank that no one at this address knows you have. You show up, you perform the role, and you let the business generate what it generates while the holding company receives its distributions and the asset grows and the cash flows accumulate in ways your coworkers assume have nothing to do with you. There is a particular kind of tension that lives inside this arrangement. Renata moves the deadline to the 14th, and you feel the deadline land on your schedule with the full weight of an actual deadline, and you adjust accordingly, and there is no asterisk. You own the building in the way a landlord owns an apartment they used to rent. The tenant's lease is real. The rent is real. The obligation is real. What the tenant does not see is what happens on the other side of the ledger. You are both sides of the ledger. The mechanism that puts you here is not complicated once you understand it. It is not obvious until someone explains it clearly. Most people in this building have never sat across the table from it. You did. You're about to see exactly how it works, how you got here without anyone handing it to you, and what quietly owning the company you work at actually costs and actually pays. Renata asks if there are any questions. You say no, there are none. The company had an owner before you. His name is Gerald. He started it in his late 30s with a partner who bought out early and a line of credit he spent 4 years paying down. He is 71 now. His knees are not good. He has a daughter in Portland and a son-in-law who works in software and no interest in learning the business, and Gerald has known this for 6 years without doing anything about it. There is no succession plan. There is no named heir. There is a company that runs well precisely because Gerald built systems that do not require Gerald, and Gerald is aware of the irony but not troubled by it. He wants out. He does not know how to exit cleanly. He has talked to 2 brokers and decided the process felt undignified and stopped returning their calls. This is the profile you were looking for, not a distressed company, not a turnaround, not a founder who ran something into the ground and needs a rescue. You were looking for stable cash flow, unglamorous operations, an owner with a timing problem rather than a business problem. Companies like this do not get written about. They do not have press releases. They have customers who reorder automatically and employees who have been there long enough to train the new hires without being asked. They run quietly. They generate real money, and the people who should be buying them are mostly looking somewhere else. You found it through a small investor, a former operator named Diane who holds a minority stake she took years ago in exchange for some consulting work and a small check. She was ready to liquidate. You bought her stake, roughly 8% of the operating company, for less than you expected. The number was $85,000. You paid it. That purchase gave you two things that no amount of cold outreach would have. It gave you access to Gerald because you were now a fellow shareholder with standing to ask questions. And it gave you credibility because you had skin in the operation before you asked for anything else. Gerald met with you twice before he took the conversation seriously. By the third meeting he brought his attorney. The valuation landed at $4.8 million. Revenue was running at $9.4 million that year. Sellers' discretionary earnings, the actual engine of the business once you add back Gerald's salary, personal expenses, one-time items, and non-cash charges, came to approximately $1.2 million annually. The purchase price represented roughly 4 times that number. That is not a steal. It is a fair multiple for a business with this profile, durable customer relationships, no customer concentration above 18%, a physical location with a reasonable lease, and a management layer that does not require the founder to be present for daily decisions. 4 times SDE for a business that does not need you to run it is a rational price. You paid it. The structure is what makes this possible on $200,000 of your own money. You formed a holding LLC. The holding LLC is the buyer of record. The holding LLC has you as the majority member. 3 other people contributed capital alongside you, none of them employees of the company, none of them people Gerald has ever met in a professional context. They are silent. They hold minority interest in the holding entity, and they receive distributions proportional to their stake, and they have no governance role. Their capital filled the equity gap between your personal contribution and what the deal required. The SBA 7A loan covered the majority of the purchase price. This is the mechanism that most people skip past without understanding. The SBA 7A program exists specifically to finance acquisitions of operating small businesses. The bank is not making a bet on your personal balance sheet. It is underwriting against the cash flows of the company being acquired. The company's own earnings service the debt. Gerald's 1.2 million SDE is what convinced the bank the loan was viable, not your salary, not your net worth, not your resume. The business is the collateral. The business is also the borrower in the structural sense because the cash flows from the operating company flow up through the holding entity and service the debt. The seller note covered the remainder. Gerald holds a note for a portion of the purchase price, subordinate to the SBA loan, paid out over 5 years at a negotiated interest rate. This is common. It is not charity. It is structure. Gerald receives his money over time rather than all at once, which has its own tax considerations for him, and in exchange the deal closes with less cash required at the table and an alignment of interest, because Gerald wants the company to perform well enough to service the note he is still owed. Total personal cash-in was $203,000, including your original $85,000 stake purchase. That is the number you underwrote your life to. That is the number that required 2 years of preparation and a degree of financial discipline that did not feel heroic at the time, and does not feel heroic now. It was a number, you hit it, you closed. After debt service on the SBA loan and the seller note, the operating company nets between $400,000 and $600,000 annually, depending on the year. Not all of that is your personal take-home. There are reserves to fund, capital expenditures to manage, distributions owed to your silent co-investors per the operating agreement, and a salary you draw as a manager of the holding entity, separate from your W-2 at the operating company. The cash is real. It accumulates through proper channels. It is reported accurately. The structure handles each dollar through the appropriate entity, and your accountant reviews every distribution before it moves. The reason this works is not complicated. Cash flow covers the leverage. The debt was sized against earnings that existed before you arrived. You did not create a projection and hope the business would grow into it. You bought something that already worked and structured the acquisition so that the existing earnings service the debt and leave a meaningful residual. Control comes from the cap table, which you majority own through the holding LLC, and from the governance documents which give the majority member of the holding entity decision rights over material corporate actions. That is you. That is documented. That is not ambiguous to anyone who has read the operating agreement, which is a short list of people who are not Renata. The deal closed on a Thursday. You drove home in traffic. You made dinner. Somewhere in Gerald's files, there is a signed purchase agreement with your holding entity's name at the top and Gerald's signature at the bottom and a notary stamp from a title company in a suburban office park. It is an unremarkable document that changed every future Thursday you will have. The cap table is a document. It lists the equity holders of the operating company and their respective percentages. After the acquisition closes, the operating company is wholly owned by the holding LLC. The holding LLC has an operating agreement. That operating agreement names you as the majority member with governance rights over material decisions. Your co-investors are listed. Their percentages are listed. Their rights, which are economic and not operational, are listed. This document exists. It is accurate. It is filed where it belongs and available to the people who have a legal right to see it. That list is short. The lender who underwrote the SBA loan has it. Your attorney has it. Your CPA has it. The closing agent who handled the transfer has it. Gerald has it because he sold the company and the purchase agreement references the buyer entity by name. These people had to know. There is no version of a legitimate acquisition where they do not. The secrecy here is not secrecy from regulators or from your bank or from the IRS. It is the ordinary professional privacy that surrounds any private business transaction. You are not hiding the structure from the people who govern it. You are simply not announcing it to the people who have no legitimate reason to be involved. The cap table does not go in the employee handbook. Your attorney holds a nominee board seat. This is not theater. Boards of private companies often include outside counsel for exactly this kind of arrangement. The attorney is a named board member. The attorney attends to governance, signs where signatures are required, and is visibly present in any document that requires board representation. You are the decision maker. The attorney is the face on the letterhead for anything that requires one. This is legal. It is common in private equity-backed companies at every scale. The reason it exists here is the same reason it exists anywhere. You are not ready to be the visible face of ownership. You may never need to be. The operating company does not require your face in order to function. It requires your decisions, your capital, and your attention. All three of those can move without anyone in the building seeing you differently than they saw you last Tuesday. A general manager runs the company. His name is Tom. Tom has been with the company 11 years. He trained under Gerald for the last 2 of those years and took over operational authority in the transition period before the sale closed. Tom runs the daily operations. He manages the department heads. He handles vendor relationships at the level that requires a face and a handshake. He attends the industry association meetings. He makes the calls that come in when something goes wrong on a Friday afternoon. Tom is excellent at this. You hired him knowing he was excellent at this because you needed someone who could run the company without requiring you to be visible in the role. Tom knows who you are. He knows who owns the holding entity. He knows your name is on the operating agreement. He was told directly in a private meeting before he accepted the expanded role and the compensation that came with it. You told him because he needed to know in order to do his job with full information. You told him once. He did not need to be told again. A part-time bookkeeper named Sandra handles the financial operations at the company level. Invoicing, payroll processing, vendor payments, monthly reconciliations. Sandra reports to Tom. Sandra's work flows up to your CPA, who handles the entity-level accounting, the distributions, the tax filings, and the consolidated picture of how the holding LLC and the operating company relate to each other financially. Sandra knows the books of the operating company. She does not have a view into the holding entity. She does not need one. Her job ends at the boundary of the operating company's accounts. Your CPA's job begins where hers ends. The department heads run their departments. Renata runs her team. The other managers run theirs. None of them have been told. There is no requirement that they be told. Their employment relationship is with the operating company. The operating company has a general manager. The general manager has authority. The chain of command is intact and functional. The fact that above Tom there is a holding LLC with a majority member who sits in a cubicle in the same building is not information that affects anyone's ability to do their job. The need-to-know standard applies. None of them need to know. Why you do not tell them is simple. You behave like an employee because in a meaningful sense you still are one. You draw a W-2 salary from the operating company. It is on the books. It is taxed appropriately. It is not your primary economic return from the investment, but it is real compensation for real work, and it keeps you embedded in the daily operations of a company you have a significant financial interest in protecting. You are not playing a role. You are doing a job and also owning the structure that employs you. Both things are true simultaneously. The W-2 also keeps you close to what is actually happening. A manager who is physically present learns things that a remote owner does not. You hear what the customers are saying before it becomes a pattern. You notice when a department starts losing efficiency before the numbers show it. You are in the building. You're paying attention. You are learning the company from the inside while the company runs exactly as it ran before you owned it. That continuity is the point. You did not buy a company to change it. You bought it because it already worked. The documents that could make someone curious, the loan covenants, the board minutes, the operating agreement, are filed in places that require professional access to reach. A coworker walking past your desk cannot find them. A vendor calling to check on an invoice cannot find them. The information is not hidden from the people who govern it. It is simply not in circulation among the people who don't. The company runs, the debt gets serviced, the distributions accumulate, the books are clean, no one is deceived, nothing is misrepresented. The structure is ordinary and legal and well documented. The only unusual thing is the person sitting in it. That person is you, and Tom just walked past. You said good morning. He said it back. Neither of you paused. There is a version of this that looks clean from the outside. The structure holds. The debt services. The distributions land. You go to work on Tuesday and behave like someone who works there. From the outside, that is all it is. From the inside, it costs something. The first thing it costs is attention. Not the productive kind. The other kind. The kind that runs quietly in the background while you are doing something else. You are in a meeting and someone makes an offhand comment about the ownership group being absentee or disconnected, and you have to decide in approximately 1 second whether to respond, redirect, or let it pass. You let it pass. You have been letting things pass for months. The accumulation of that is not nothing. It is a low-grade tension that does not have a name but is present most days in some form. You are not paranoid exactly. You are just always slightly edited. Every sentence you speak in that building goes through a filter that most of your coworkers do not have. That is the permanent tax on the arrangement, and no one can pay it for you. The second thing it costs is ordinary. You cannot talk about the thing that is most true about your professional life with most of the people in your professional life. A coworker named Marcus mentions he is thinking about starting something on the side and asks you if you have ever thought about owning something. You say yes, you've thought about it. That is the honest answer. It is also the only answer available to you in that moment. The loneliness is not dramatic. It is just a version of being in a room where everyone is talking about something and you are talking about something adjacent to it, carefully, and hoping the distance is not visible. Then there is the conflict risk. Tom is good at his job. You hired him knowing he was good at his job. But Tom's priorities and your priorities are not always identical. Tom manages to a quarterly rhythm. He focuses on the numbers that are legible to the people he reports to, which includes the lender and, invisibly, you. He makes decisions at the operational level that are sound by the standards of a general manager. Some of those decisions, over time, will be decisions you would make differently if you were making them openly. A vendor contract that gets renewed without a renegotiation because the relationship is comfortable. A department head who underperforms and gets managed softly because the cultural disruption of a harder conversation feels costly. You see these things. You have the authority to address them. You address them through Tom, indirectly, in a way that preserves the structure. This works most of the time. It is slower than it would be if you were visible. It requires you to be a skilled communicator inside a constraint that did not exist when the business was Gerald's. There was a Thursday afternoon in month 9. Sandra was printing something at the shared printer near your workspace. The printer jammed mid-job. She cleared the jam and the pages that came through with her document were not hers. They were the tail end of a legal summary you had printed earlier and not immediately collected. 3 pages. The third one referenced the holding LLC by name and included a line about the management structure. Sandra looked at the pages the way anyone looks at pages that are clearly not theirs. Briefly, the way you scan something before setting it face down. She set them face down. She looked at you. You were already walking toward the printer. You said, "Sorry, I sent something to the wrong queue." She handed them to you without asking. You said thank you. She went back to her desk. Nothing happened. That was the entire event. You went back to your desk and sat with it for approximately 20 minutes, before you were able to think about something else. The structure held because the structure was legitimate. If Sandra had read every word on those pages, she would have found a legal document describing a legal arrangement. There was nothing there that required concealment. There was nothing there that was false. The discomfort was not about exposure. It was about timing. You were not ready to answer questions you had not been asked yet. The document gave nothing away that would have mattered legally. It mattered operationally, and that distinction is the one you carry with you. The operational risk sits differently when you are the owner. A bad quarter is not a bad quarter. It is a question about debt coverage and distribution timing and whether the lender covenant has headroom. A key customer that goes quiet for 2 weeks is not a sales problem. It is a concentration risk problem that you identified in the due diligence and have been watching since. When the GM makes a mistake, the mistake belongs to you in a way it does not belong to any employee who witnessed it. You absorb those things without being able to explain to anyone in the building why you are absorbing them. That is the price of the position. It is not a complaint. It is just the accurate cost of the arrangement. The anonymity also slows things you want to move. Culture change is slow when you cannot speak openly about direction. You can influence through Tom. You can influence through decisions that manifest as policy without origin. But you cannot stand in a room and say what you actually believe about where the company should go and have it land with the weight of what you know and who you are. The trust is concentrated in a very small number of people. The leverage on culture is indirect. That is a cost. And then there is the other thing. The thing that is harder to articulate and easier to feel. You walk the floor on a Wednesday morning. You know what every department produces. You know the debt structure and the distribution schedule and the 3-year plan and where the risk is concentrated. You know the name of the lender and the terms of the covenant, and the customer that represents 22% of revenue and what a contract renewal there means for the year. You know all of it. You are present in a building where you are the majority owner and no one is performing for you and nothing is staged and the information is real because you are close enough to touch it. That is not a small thing. That is the point of the whole structure. You did not build it to be recognized. You built it to be accurate. And on a Wednesday morning, walking a floor you own in a company that works, accuracy is the only thing that matters. Here is what you actually have to decide. Not whether to own quietly, but what you are optimizing for. Control moves faster when it is visible. Cash flow is the same either way. Anonymity protects the culture that already works and costs you the ability to accelerate the one you want to build. None of those trade-offs disappear. They are the structure. If you're thinking about which of those you would choose, Leave it in the comments. And if you want to keep following the mechanics of how ordinary people end up owning the rooms they work in, subscribe. The next one continues exactly where this one ends.